What is up, everyone? Welcome to Investing Club. In this video, I'm going to be analyzing GNUS brands. Their ticker is GNUS, and I'm going to see if they are a buy at the current prices they are trading at. And this is a stock that has gotten a ton of hype recently, and their stock price has exploded. So I'm going to go through some of the information about this company and give you my thoughts. This is not financial advice, and I'm not a financial advisor, and you should always do your own research before buying a stock. So let's get right into it. Here is the presentation off their investor relations page. And so GNUS Brands, they are a global media company that is in children's entertainment. Here is the chairman and CEO, and he has a lot of experience in children's television. You can see all the names of the shows that he's produced. And he was former chairman and CEO of DIC Entertainment, which was sold to the Walt Disney Company. They have three pillars of value creation: their portfolio of brands, their consumer products and distribution, and their own distribution platform. And here are some of the brands they have. They have one that's been getting a lot of attention is Stan Lee, and they recently signed Arnold Schwarzenegger to be on one of their shows. So a lot of these shows are getting a lot of hype. This is a show that's on Netflix. So a lot of these shows are being played on Netflix and different channels. I think one of them is on Nickelodeon too. So this company basically creates these shows and then licenses them out. This show's on Nick Jr. This one is the Stan Lee show is on Amazon Prime. And they also sell the consumer products, so pretty much just toys and clothing. And they recently launched their own channel, which I think launched a couple days ago. So now they have their own distribution platform where they will be playing their own shows, which I think is heading in the right direction for this company. I think that is a plus. So you don't have to be paying companies like Netflix and Amazon. And they look to pre-sell 75% of production costs, which is a good thing. So they know the demand for the shows will be there when they're spending millions of dollars to develop these shows, which is definitely a good thing for a company like this that is losing money. That's definitely something you want to see. Okay, so that is it for the investor presentation. So now I'm on their annual report, and the biggest risk I found with this company was that their common stock is about to be diluted a ton. So they issued 2020 convertible notes. You can convert them at a price of around 137 per share. And so the stock right now is trading way above that. We can check that. The price is at 391. So odds are that these notes will be converted into stock. And so the shareholders of this company are going to see their shares diluted by a pretty large amount, which is not a good thing if you are a long-term shareholder of this company. And this might happen more in the future. This company is going to need to raise more cash at some point. They had this in their annual report as well. They're dependent on funding. They're still needing to raise money because they have a lot of development costs and they are not profitable. So they have to find financing somewhere to fund their operations. And so that's going to lead to either more debt or more equity, either of which are bad for long-term shareholders. They also have warrants that are outstanding right now, and the exercise price for those are $3.90. So a lot of those probably were exercised when the stock ran up to over $10. So that's something to keep in mind as well. Okay, so we can take a look at some of this company's fundamentals with FinViz, which is the tool I like to use most. And so at first glance, they're losing money and they are at a insanely high valuation right now. Price to sales is a 72. So companies that aren't profitable are usually valued based on price to sales, and even that for this company is higher than pretty much anything I've ever seen. Their sales have been growing at 44% a year, so that is an encouraging sign. Their revenues are growing fast, and they should continue to grow fast as they produce more content. And for the debt, I'm not concerned with their long-term debt. Their debt to equity is a 0.5, so it's not too concerned. In the short term, there is a concern with a current ratio of 0.5, so they have more current liabilities than current assets. So again, they're probably going to have to raise money to combat some of that, which does hurt shareholders, whether it's in the form of more debt or issuing more equity. So now we can take a look at the income statement. And like I said, the revenue is growing. They made almost $6 million in revenue in 2019, which is a huge jump from what they were seeing a couple years ago. And so their biggest expense are the selling and administrative expenses, as well as they had a big jump in unusual expenses. I'm not sure exactly what that is. So that is something to take a look at, because that more than half of the amount of their selling and administrative expenses. So that's something to keep an eye on. And it was a jump from 2018, but we can come down and their net income was negative 11 million. So this company has been losing money and it doesn't look like it's going to get better. We're probably going to see a huge jump in revenue with a lot of these licensing deals that this company recently entered into, and eventually they will become profitable as they scale back their production and they can find ways to cut costs. But ultimately, I don't ever see this becoming a huge company. They're going to stay one of these tiny companies. There's sort of a limit on how much you can bring in with broadcasting and television shows. It's a relatively small market, and the specific niche that they're in, the more educational shows, it's never going to reach a huge audience where they can start bringing in billions of dollars. So this is always going to be a small cap company. They will become profitable eventually, and eventually their margins might become pretty good once they can really cut back on their costs and they have a solid portfolio of shows. You can see the shares outstanding have been going consistently up over the last 5 years. So this company is diluting their shares every year, and it looks like that's going to continue until they're able to break a profit. These shares are going to be diluted. So here we are on the cash flow statement, and their net operating cash flow increased in 2019 compared to 2018, which I like to see. Even though it's still negative, it is a move in the right direction. And we can come down to free cash flow, even though that is negative, and we did see growth of 21% of the free cash flow. So that's an encouraging sign. I think this company is moving in the right direction. For me, it's sort of just waiting to see if this company gets there and when they will get there. At this point, it's not really clear when they'll become profitable. And at that point is where I would take another look at this company to see if they are worthy of an investment once they become profitable, and it will be easier to predict what their earnings will look like. And so the price to book of this company is a 30, which is way overvalued. Even though book value doesn't really matter as much to companies like this, it's still way too high of a price to be paying, in my opinion. And so this is one of the most interesting things I found with this company. This company is owned 78%, almost 80% owned by the general public. And that is a very encouraging sign where you see a company that the public owns the majority of the shares and it's not well known to institutions. And this is something that goes back to one of Peter Lynch's books where he talks about using an advantage of you as a consumer to find trends early before institutions do. And so obviously that's the case here, where this stock was undiscovered by institutions, and now it is likely to be brought into the spotlight as there's more news coming out about this company and the new deals they've closed with Netflix. So even though this company is overpriced right now, in the long run, if we see institutions start to go into this stock, especially since it's a small cap company, we could see the price appreciate by a pretty good amount. Again, that will also mean it's more volatile because the general public tend to buy and sell more than a hedge fund or an institution would. But that's something to keep an eye on if we see institutional ownership keep increasing in this company. And so where are we right now? Earlier this month, the stock almost got up to $12, and we've come all the way back down to under $4. So would I buy it here? Probably not. It's still overvalued for a company that it's not clear when they're going to become profitable. But if this stock did get down to under $1 again, which I don't know how likely that is, we might see this sell-off continue or we might not. If it ever gets down back to those levels, it may be worth taking a little nibble out of the stock because I do think they have a bright future. It's just a question of when that's going to happen. So to me, this looks like a speculation. It would not qualify to be a large position of my portfolio. But if it did fall down to those levels, I might take a nibble at it and just hold it as a speculative play in my portfolio. And in the event that this company continues their forward progress, it could be a pretty good investment to hold for a number of years. So that's it for my analysis on this company. Let me know what you think. So let me know if you were buying the stock on the way up to $12, or let me know if you're thinking about buying it now or waiting for it to go down more. I'm interested to see what you have to think with a volatile stock like this. And so let me know, and I'll see you on the next video.